today's session from the Estate Agency Affairs Board, and it's a Continuous Professional Development Session, or CPD as you might know it. I'm Rona van Huppen, and I'm representing ATCOR today. We're doing this session on effective budgeting and operational cost control. One of the things you might agree with me that is very important in any business that you run. Let's look at what we're going to do today, or to talk about today. We're going to start out with cost classification. There's no way you can really manage your cost and do budgets if you're not sure about what the cost classification is, what's indirect, direct, fixed and variable costs. Then we're moving over to budgeting, the motivation for budgeting, why you need to set budgets. Any sub-budgets you can do for the master budget, forecasting techniques, and new developments in budgets. We call it new developments because it's not what you might be used to, but some of you might have done something like that before. Then measuring performance. After you've done your budget, you need to check if you've done on the budget, or if you've done actually what you wanted to do on the budget. There we're looking at variance analysis, value chain analysis, and then some qualitative aspects. Regarding cost behavior, remember we said that we need to know how costs behave in order to know what we can do with that costs, and if that costs are manageable, if it's not, how we need to go about budgeting and forecasting for that costs. So first of all, a few definitions. Cost behavior deals with how that cost will react to changes in the activity level. The activity level can be anything, and we'll talk about cost objects now, anything that you are allocating the cost to. If that activity level rise, would the cost also rise? If that activity level rise, would the cost stay the same? And then our cost object, you'll hear a lot about cost objects. That is a single product, service, or project to which costs are allocated. We'll get to the allocation now, so don't worry if it's all Greek to you. Let's first start out with a few definitions. A fixed cost. A fixed cost remains constant regardless of your total level of the activity of that cost object. Obviously within the relevant range, we'll get to the definition of the relevant range now as well. Then your fixed cost would decrease per unit if your level of activity would increase. Let's look at a few examples. If you think about rent of an office space, you pay the same monthly rent regardless of how many properties you rent out to customers. You pay the same monthly rent for your office space regardless of how many houses you sell. That office space stays the same. But as soon as we start allocating the cost, if I sell one house, the full cost would be allocated to the one house, if we're trying to calculate a cost per unit. If I sell 10 houses, the cost would be allocated between 10 houses. So you can see that the cost per unit would decrease as more units are carrying the cost. You can follow me on the little graph at the bottom there. You'll see we've got total cost and our activity level. Regardless of that activity level, the total cost stays the same. Now we're looking at variable cost. That variable cost varies in direct proportion with the level of activity. It stays constant per unit, but the more the level of activity would increase, the more the cost would increase, the total cost. Think about wages paid. If you are taking a temp to a house that you're showing, you're paying that temp 500 Rand per hour. The level of activity in this case would be hours. If the temp stays there for 1 hour, you're going to pay him 500 Rand. If he stays there for 2 hours, you're going to pay him 1,000 Rand. So that cost increases in total in line with how many hours the temp spends at the house that you're selling or that you're showing. Then, wages per hour we've covered. You can also pay for photocopies per copy. So if that photocopies increase, you'll have a higher level of photocopying cost at the end of the month. Again, I'm going to take you to the graph that we've got. There we've got total cost and the activity level. Can you see that the more the activity level increase, the more your total cost would increase? Then, all of this is very nice to look at fixed and variable, but that only holds within the relevant range. A relevant range is that range of activities where the cost objects assumptions would hold, or where the assumptions regarding cost behavior would be valid. If we look on the next page at the graph there, you can see the cost would increase as the level of activity increase, but it doesn't increase in a straight line, it increases in steps. A good example, and you all know about manufacturing because we're all consumers, a good example there would be if I rent one machine to manufacture a certain number of units. Let's say my rent is 10,000 Rand per month and I can produce 1,000 units with that machine. Regardless of what I produce between 0 and 1,000 units, I'll still have to pay the rent for the machine, the full rent for the machine. If I want to produce more than 1,000 units, I'll have to increase my machines to a second machine, again paying the full rent, but manufacturing anything in the range between 1,001 units and 2,000 units. So in this case, our relevant range would be 0 to 1,000, 1,001 to 2,000, etc. And as you can see, within that relevant range, the fixed cost stays fixed, and the variable cost would increase with the number of units or the activity level. And it's very important to understand the difference between fixed and variable cost, as well as what happens to the relevant range, as that is the only way we can really forecast our cost and really budget for our cost. Now we've done fixed and variable. There's such a thing as a mixed cost as well. That is a cost that has a component of a fixed cost and a component of a variable cost. So in the total cost, there's a portion that would stay fixed regardless of the activity, and then there's a portion that would increase with the activity level. We need to split that between the fixed and variable components to really be able to take decisions on the cost and to really be able to do forecasting on that cost. Examples would include your telephone cost. Think about that bill you get every month. There's a fixed portion for the line rental, but the more calls you make, the more your telephone cost increase. So the line rental would be classified as a fixed cost, and the portion of calls would be classified as a variable cost. But you get the total account, and that includes the fixed cost and the variable cost. So that is classified as a mixed cost. Then another example would be your municipal account. You get certain fixed charges on there, but it's also variable in terms of your water and electricity usage. Let's quickly go to the graph. If you look at the bottom here, we've again got total cost and activity level. If you look here, you'll see that even if I have no activities, I'll still have a fixed portion. That means that fixed portion goes ahead no matter if I use the phone or not, no matter if I make a call or not. Then we're moving over to cost classification. We've looked at how the costs behave. Now we need to look at how we can classify the cost. The first two, direct versus indirect, are two cost classifications. And then I've just included opportunity cost and sunk cost for you. It's also good concepts to keep in mind. First of all, direct cost. Anything that can be traced directly to a cost object. Examples would be, if you have a show house and you have specific costs that is only applicable to that show house, that would be direct cost in terms of the show house. If you've got specific admin cost relating to your rental property, that would be direct cost in relation to the rental property, which is the cost object at that stage. Again, think about the whole concept of direct costs. We say it can be directly traced to that object, which makes it variable most of the time. If it's fixed, it's more difficult to directly trace it to the cost object. Indirect cost or overheads. You'll hear sometimes I'll refer to indirect costs, sometimes I'll refer to overheads. That cannot be traced easily to the cost object. It's not a specific cost that you can see only happens when that activity of the cost object is done. So examples there would include the rental of the office space. If I'm renting the office space, I cannot tell you this square meter was for that rental property, or this square meter was for that house that I had on show, because it's very difficult to trace it easily to the cost object. Also, cleaning the offices. If I've got cleaning services at the offices, that would go ahead regardless of the number of properties that I'm renting out or the number of properties that I've got on show. Two of the important cost concepts that you also need to understand in order to really do your budgets effectively and to also take decisions based on that cost is, the one is opportunity cost. That means the potential benefit given up if one alternative is selected over another. For example, the choice for a consumer or a customer between buying and renting. If they're renting, then they have the monthly rent that they have to pay. If they're buying, then they have to pay the lump sum up front. So you can have the choice between the two, and that would be the value of that choice. Either the value of the rental payments or the value of buying the house. Then, sunk cost. That is something that happened in the past, a cost that's already incurred, and no matter what you do, it cannot be changed by a decision now or in the future. If you think about the house you bought years and years and years ago, nothing you do now can change the fact that you bought that house and you spent money on that house. It's done, it's been done in the past, and that is a sunk cost. Just important for decision making is to keep in mind that as you cannot change a sunk cost, it is not worthwhile to dwell on a sunk cost. It's better to look to the future to see what we can change in the future. Then regarding cost allocation, that is where we're taking our indirect cost or our overheads and we're allocating it to cost objects. Let's just quickly recap. Indirect cost, we said it's not easily traceable to a cost object. And a cost object, we said, that is some sort of activity that we want to allocate the cost to. If you want to know how much your total cost would be per house that you sold, or your total cost in terms of a rental property, we would have to get some way to allocate indirect costs to that cost object. Indirect costs can be fixed or variable, but the largest portion is normally fixed. Then we're getting to another definition, activity base or allocation base. That is the measure of the activity with a causal relationship to a specific indirect cost. Let's take office rent, for example. Office rent is not variable, you pay a fixed rent per month. But floor space would influence that office rent in the long run. So floor space can be a perfect activity-based or allocation base. Then we have a predetermined overhead allocation rate. The reason we're using a predetermined overhead allocation rate is because you do not know at the beginning of the year what your total overheads would be. You'll probably only know that at the end of the year. So what we're doing is we're taking our best estimate and we're getting a rate at which we're going to allocate that to different cost objects. And if you look there on the slides, you'll see that we've got a formula with which we do it. We take the estimated overhead and divide it by the estimated activity. That gives us a rate per activity. It can be hours, it can be floor space, it can be anything that you feel has got a causal relationship with that indirect cost. Then as the year progresses and we've got that activity, then we apply the indirect cost. And that is where we've got the formula right at the bottom there. Overhead rate times actual activity. And then we can get an estimated cost per unit. And then also regarding our cost allocation, I've spoken about a causal relationship. That is called a cost driver. We use the activity that would drive that cost. So that's the activity with a causal relationship to that indirect cost that we can use as an allocation base. We can have allocation rates for each and every indirect cost to be allocated. You can choose within your own agency what makes the most sense in terms of allocation of cost. Then, as I've said, the allocation rate needs to be determined at the beginning of the period. We cannot wait till after year end to know what a certain cost object has cost us. And then if you want to drill down into overhead allocation and do a little bit more calculations, you can calculate an over or under applied overhead. We've got under applied indirect cost or under applied overhead if the actual indirect cost is greater than the applied indirect cost. Let's think about it for a minute. We say the actual indirect cost is greater. That means throughout the year, with the allocation, I haven't allocated enough. And when the actual indirect overhead comes, we see that it's more than what we've allocated. Over-applied indirect overhead is during the course of the year, we apply more and more and more as that activity progresses. And then at the end of the year, we see the actual overhead was not that much. That over or under applied indirect overhead, you can just write off to the income statement. That brings us to cost allocation in terms of activity-based costing. That ABC stands for activity-based costing. Activity-based costing is a way in which you allocate your cost more accurately. It might not be applicable to each and every single one of your indirect cost pools or your overheads. But when you're allocating that, you try and drill down as deep as possible in terms of your overheads to get a causal relationship for every one of your overheads. And that would make your allocation much more accurate. So the steps we would take is we would first identify a cost object and allocate all the direct costs to that cost object. Remember what we said? Direct costs are easily traceable to that cost object. Then we classify the costs into activities, functions, or cost pools. And that cost that's been classified into that activities, functions, or cost pools would be what we would allocate by means of a cost driver to the cost object. Remember again, I know I've said it before, but it's very important. It's no use allocating the cost if there's not a causal relationship between that indirect cost and the cost driver. You won't get accurate cost allocation if there's not a causal relationship. Then we can compute the rate per cost driver the same way with the same formula as we've done with normal overhead and allocate that to the cost object. ABC or activity-based costing leads to more efficient cost allocation, but unfortunately it's costly and difficult to implement. So you can decide on what would work best within your agency. That brings me now to the topic of budgeting. And I know budgeting is not everybody's favorite, and it's also not everybody's favorite to try and stay within the budget. So I thought of starting out with some motivation for why we're doing budgeting. Budgeting is a tool to facilitate planning and control in order to reach our long-term objectives. There's no way that we can reach that long-term objectives if we've got nothing to measure it by. And the budget is the perfect way to measure that by. Then, the planning process assists in establishing objectives, identifying and evaluating the strategic options, implementing plans, and monitoring outcomes. You can see it acts like a roadmap to get you to that strategic objectives. Budgeting provides guidance to employees as well as motivation to reach goals and targets. If they know they're being measured, chances are they'll try and achieve their targets. Then budgets can either be imposed by management or set in participation with all employees, depending on what you would like to achieve. Employees normally feel more valued if they're part of the budget, but they can also set their targets too low. So be careful which one you choose. Then, as I've said, effective budgeting provides both planning or a roadmap and control. It facilitates performance measurement. A little bit more about performance measurement later on in the presentation. Then I've included a few examples of budgets that you can use. This budget would differ between agencies, as the different agencies would have different types of income, different types of expenses. First of all, the income budget. There I've included an example where you can start with your rental properties and what you get per property to get the total income from rental. You can see the information content of that sub-budget is important in terms of the number of rental properties as well as the admin fee per property. So we're not only looking at the bottom line, the total income from rental. We're looking at the number of properties and the admin fee per property. And that is easier to manage if you break it down into the different subsections. Or for the property sold, the commission from the sale. Now I know what you're thinking. She doesn't know that we earn different commission amounts on different sales. I do know that. But this is a way in which to facilitate a planning process going forward. Remember what I've said? Apply this budget to your specific agency. This is just an example. You can tweak it however it would fit your agency best. Another example, if we're looking at direct cost, again, what did we say? Direct costs are easily traceable to that specific cost object. Again, I've taken the example of rental properties and properties to be sold. Each one of those would have a specific direct cost that's only for that property, be it rental or properties to be sold. Include that in your direct cost budget, and then it's easy to control in terms of what you're planning on spending. Then an indirect cost budget. Again, let's think back. Indirect cost, not that easy to trace back to an individual cost object. So what we've got there is, you know by now we've got a variable portion and a fixed portion. This budget makes allowance for both the variable portion and the fixed portion. Again, change it as it suits your agency. Then, very important, the cash budget. You'll agree with me, it doesn't matter you're making a profit. If the cash is not there, then you can run into trouble. This is just also an example. Cash receipts from wherever it comes, cash outflows. There's populated examples in the handouts that you will be getting. But again, take the format and make it your own within your specific estate agency. Then, also important, prepare the budgeted income statement and budgeted balance sheet. We've looked at the sub-budgets, but now you need to pull it together and do it on the income side as well as on your asset side. Then forecasting techniques. You remember we spoke about forecasting techniques right at the beginning where I said you can't use a mixed cost to forecast if you haven't split it between fixed and variable. So this is one of the techniques that is often used to split the fixed cost between fixed and variable, or the mixed cost between fixed and variable, and make sure you can use it to forecast. You'll see we're using the formula for a straight line. We can use that because we're assuming that the variable cost per unit would stay the same. So you'll have a linear relationship. Y represents your total mixed cost at a certain activity level. A, your total fixed cost. Because remember that fixed cost stays the same regardless of the level of activity. B, the variable cost per unit of the cost driver. And we times that variable cost per unit by the activity level to get the total variable cost at a certain activity level. If the values of A and B are known, you say, thank you very much. You plug your activity level into that line and you get your total mixed cost for that activity level. Unfortunately, A and B is very seldom known, and then you'll have to take your mixed cost over a period of time and split it between the fixed and variable component. As we've said, B represents the variable component, and that's the way in which you calculate it. The change in the total mixed cost. The highest total mixed cost minus the lowest total mixed cost. That would give you the change in the mixed cost. Divided by the change in the activity level. So it's the highest activity level minus the lowest activity level. Let's first explain why we can do it. Why can we just deduct activity levels from each other? If we assume there to be a linear relationship in terms of the variable cost, then any change in the total cost can only be as a result of an increase or a change in the activity level. Because the fixed cost will stay fixed regardless of the activity level. The total cost might increase in line with the activity, and that would represent the variable portion. And then you can calculate A from what you've got on the different activity levels, and there's also an example of that in your books. Please go and have a look at that, because it might just come up in the multiple choice questions. Then regarding new developments in budgeting, as I've said, you might have heard about a lot of the what we call new developments, but some of them has not been implemented yet into your way of doing budgets on a daily basis. First of all, we've got the rolling budget, and I'm going to go through each one in terms of what it entails and why we might use it. You can go and decide what is relevant for your estate agency. Starting with rolling budgets. The budget is adapted and rolled forward when new information becomes available. So you can realize that as we adapt it and as we roll it forward, as that new information becomes available, we'll end up with a continuous budget for 12 to 18 months. Because it's updated every time that the information becomes available. Then we've got Kaizen budgeting. Kaizen means continuous improvement. And the budget focuses on continuous improvement. So it focuses on reducing the cost by continuous improvement. That means while we've got that budgeting process, we are going to look in detail at every single one of the expenses and see if we can improve it and if we can decrease it. Then, activity-based budgeting, that follows the same principles as our activity-based costing that we've already spoken about. So the focus in the cost of the activities are needed to facilitate each service or process. So we're looking at that in terms of what activity drives my total cost, and how can we budget for that in terms of the activities driving the total cost. Then zero-based budgeting, we start from zero with every budgeting process. You can think that that's not very popular, but it does help a lot to make sure you justify each and every one of your expenses in your budget. Then we're getting to a variance analysis. A variance analysis might be difficult for you because you will have different income and different expenses on your budgets. But what we're trying to do with a variance analysis is we're looking at budgeted income and expenses versus actual income and expenses. What should I have spent versus what did I actually spend? So we'll do it for income and we'll do it for expenses on a line-by-line basis. You'll see I included 2 examples of formulas that you can use in terms of income. It might differ within your agency. So use that as examples if it would help you to calculate the variance in terms of the income. You'll see what these 2 formulas do. The first one is actual fee that we're getting in per property compared to the budgeted fee that we thought we would get in per property. So that is the difference on fees. The second one is actual number of properties minus budgeted number of properties. So there we look in terms of the volume. Did we get the volume that we thought we would? Then expenses can be analyzed on a line-by-line basis. That's what often works the best. What should have been spent versus what was actually spent. Then just a few things regarding variance analysis and what to look at. You need to compile a variance report on a monthly basis, and preferably in table format because it's easier to manage then. You need to break the variances down into the different causes of those variances. Did you pay somebody a higher rate? Did you receive a lower income than you thought? Did you work longer hours than you thought you would? And as a basic rule of thumb, we need to investigate all large negative variances. Because we're losing money, we're paying more than we should. Unexpected large positive variances, because that can have a detrimental effect later on in our statements. And then any negative variances, albeit small, where we weren't expecting any variances. You can designate a responsible person, and that person should investigate and give reasons why the variances happened, and obviously compile an action plan going forward. It's useless to look at the variance analysis and do all of your variances if you don't have an action plan going forward. That brings us to the value chain analysis. Although not strictly costing, and although not strictly applicable to service organizations, I still wanted you to just understand what the value chain does, and you can go and implement that in terms of your specific agency. The value chain works with our primary activities. You would probably have some sort of inbound logistics, very little operations in terms of you're not a manufacturing company, but you would have some sort of outbound logistics. How are we dealing with whatever comes in? How are we dealing with what goes out? You'll definitely have a large portion marketing and sales, and you'll definitely have a large portion services. Now, what do we do with this? We take our specific agency and go and plot what we've got to that specific value chain. Who does the marketing? When is it done? How much do we spend on that? All of that would go into marketing and sales. Who does the services? Who's the admin people responsible? How much do we pay them? That would go into services. Then at the top there, we've got support activities. That's activities that support your primary activities. You'll have most of those: firm infrastructure, human resource management, technology development, and a little bit of procurement. Not a lot, because again, you are mostly a service company. And again, you'll take your support activities and go and plot it on that value chain. Now that gets me to the important thing of why we're doing the value chain. As soon as you've plotted all of your activities, what it's bringing in and what it's costing, you'll get a very good idea of what expenses are not adding value. And then we can eliminate all of the expenses not adding value. Just a few qualitative aspects to finish off with. Remember that budgets are only a guideline. Other factors should also be taken into account. There's no use setting a budget and staying by that budget and making everybody around you unhappy. You need to look at the people factor as well. And then, efficient budgeting processes facilitates useful budgets. That means where we start with our budget and how we do the process as efficiently as possible would make sure that we've got a useful budget. Then regarding performance management, that is obviously very difficult to see if we've reached our targets and to see who was responsible for either reaching it, that we can praise them or give them bonuses, or for not reaching it, that they can be reprimanded. Remember, it's a continuous process. We've said that it's good to compile a report monthly, but we still need to know what's going on throughout the entire process. You need to follow a logical process when investigating the variances, and some variances might be expected due to economic circumstances. Then we know it's coming and we know we'll have to deal with it. And then, very important, there's a feedback in terms of variances. We need to take whatever happens on our variances and feed that into the rolling budget, because that constitutes the new information that becomes available. Thank you from my side. Thank you for your time and thank you for listening. I would just like to remind you that in order to get your CPD points, you need to go and do the multiple choice questions. Thank you.